going to call to order the meeting of the Finance Investment Committee of the Vallecitos Water District today, Monday, November 16th at 4 p.m. via teleconference. Items for discussion are four. We're going to start with number one, audit results and comprehensive annual financial report.
Okay, I'm just going to turn it right over to Wes. Wes is the star of the show today.
I actually get to pass off that privilege to other people today, I think.
That's all right.
So let's see. So we have two guest speakers today. Hopefully it won't be difficult for them to share their screen. It shouldn't be, I imagine. See if I can share mine. Good evening. Welcome to the Finance Committee meeting on November 16th, 2020. Tonight, like as I mentioned, we have two guest speakers. We have Shannon Ayala, and I'm never going to be able to pronounce Jenny's last name. Maybe Jenny can help me out with that one.
Sure, it's Jenny Linkowitz.
Thank you, Jenny. So the agenda for tonight, we'll be talking about the audit results in the CAFR. Then Shannon will present the audit results in the CAFR. And then Jenny will present the investment policy updates. She will also present the investment portfolio update. And at the end, we'll give just a brief update on the CalPERS ADP and the next steps. So to start it off, I'll pass it over to Shannon to present the audit results in CAFR. And let me stop sharing my screen.
Thank you, Wes.
Somewhere here we go. Stop.
It's a coordinated effort.
Yes.
Let me start my slideshow and then I will share mine. Okay, share screen. Okay, does it look good? Can you see it? Says
it looks
Water,
good.
Vallecitos Water District audit results.
Yep.
Okay.
Looks good.
Okay, so I'm here today to report on the audit for the fiscal year ending June 30th, 2020. We issued on here it says the basic financial statements, but we actually issued the comprehensive annual financial report, so the CAFR, and we issued that with an unmodified opinion dated November 12th, 2020. This is the highest level audit opinion that can be received on the financial statements, and it indicates that the financial statements and footnotes are presented fairly in all material respects and in accordance with generally accepted accounting principles. And we also issued the communication to those in governance and the government auditing standards opinion. There were no material weaknesses or significant deficiencies in internal controls. There was one other recommendation that would warrant the attention of the committee, and that was a recommendation to review projects that are in construction in progress to ensure they're properly reported. So this basically, it says capital asset project, but there are a variety of projects in construction in progress, including engineering projects and reimbursable projects. So we just want to make sure that finance is aware of those and knows that those should be expensed and reconciled at the end of the year so they don't get left in construction in progress, which would then result in CIP being overstated and expenses understated. I'll let Wes kind of pipe in at the end if you have any questions on the process for that recommendation. And then the audit results are the finance staff, as always, was prepared for us to perform the procedures that we needed to do. It's always a little bit of a challenge when somebody new steps into the role. So since Anthony left for Washington and Michael stepped in, it was a smooth transition though, so we're thankful for all of the help that they did provide. We didn't have any material audit adjustments detected during the audit. However, there were a few immaterial audit adjustments that were made. We tested compliance with the California Government Code and the investment policy. We also test debt compliance and compliance with the procurement policy, and we did not have any items of exception with any of those. We had a few areas of audit focus this year. So in addition to our normal audit procedures, which include testing all the material, balance sheet accounts, and then analytically testing the revenues and expenses, we do some focused auditing on construction in progress, other post-employment benefit obligations, and then disbursement testing. So for the CIP, we tested approximately 50% of the projects that were in CIP, and we talked to project engineers. We do some individual disbursement testing just to ensure that those projects are properly reported as CIP. One of the small adjustments, that immaterial adjustments we had, was related to CIP. So for other post-employment benefit obligations, we obtained the new actuarial valuation that was issued this year, and we test the census data that was provided to the actuary for that underlying data. We test to ensure that the plan selected is correct, the birth dates are correct, the genders, and a couple of other attributes, and we didn't have any exceptions noted as a result of our procedures as far as that's concerned. For disbursement testing, we obtained all of the bank statements for the year and the check register. We took that information and input it into our data mining software and matched up all of the disbursement transactions per the bank statement to the check register, and we investigated any transactions that did not match up. So for example, transactions that straddled fiscal years, or if there were voided transactions that may not have ended up in the bank statement, we verified those, and we did not have any exceptions noted. And then I just wanted to let the committee know of a couple of upcoming governmental accounting standard board pronouncements. So that will be implemented in the coming year. So GASB 84, which covers fiduciary activities, and then GASB 87, which covers leases. So we'll meet with Wes and the team next year during the planning meeting to determine if either of these pronouncements will affect the district, and we will assist them with the implementation if necessary. With that being said, I'm happy to answer any questions that you may have. And I'm going to try and stop sharing my screen if I can find the button.
And if I can jump in real quick, this will be presented to the board on Wednesday.
Yes.
And maybe a question for either Shannon or Wes. The contractual agreement we have with Davis Farr was for 3 years, correct?
Yes.
Where do we stand on that timeline?
This is the last year of that timeline. So we have the option in the contract for 2 one-year renewals at the discretion of the board. So we'll have to bring that back soon, I guess, to find out. Well, before the next audit. So we have until next fiscal year end.
Right.
That's a good question, Glenn. I know in our water board training, the little bit of training that they give us, they do mention as a best practice that we should change firms from time to time. And I think this is the 3rd firm that I've worked with since I've been on the board. And I will say, I think I said it before, but this has been my favorite. I think they do a really thorough job, and I really like how they present the information, and it leaves little room for, me having to clarify something or ask questions. And so that's really nice. So I definitely, just one board member's opinion, would be willing to at least look at a 1 more year extension, and we can, talk about the 2nd year at some other point. But if that is going to come up at a future board meeting, I'd be supportive of that. As far as this presentation tonight, I didn't have any questions, but I did want to hear what Wes's thoughts were about the recommendation on the CIP and the construction projects, and how you might be able to keep us up to date on that as we go forward at future finance meetings.
Yeah, absolutely. So we discussed this, I think we talked about it last year and this year as well, but we have different types of projects. We have the capital projects, we have engineering projects, which are developer projects done through engineering, and they work together on those. We have reimbursable projects. So someone like hits a fire hydrant and we need to bill the insurance company, we track those, and we track them all through project numbers. Currently, our system that we enter those into, which is Maximo, it's an IBM software. It's been set up to all charges to projects go to an account construction in progress. So without saying the account number, which is 1720, it's construction in progress. So they're all set up the same way. We've been working with IT to set it up so that we can have it go straight to an expense account to track the expenses. So what happens with developer projects is they typically give a deposit. So they come and they say, I want to work on this project. Here's, $5,000 or whatever, because I expect it to cost that. So that we start to work on it and we charge against that $5,000. Well, currently it's going to construction in progress, and it could be just charged to an expense to offset that liability, that deposit. So we're working with IT to see if Maximo is capable of charging to an expense account instead of charging to the construction in progress. We've been working on it for a little while, and Thomas actually thinks that we can do it. So hopefully by next year we'll have that set up. It'll be good for certain things like COVID and emergency projects as well, because those are being charged to construction in progress too, and they really just need to be tracked through a project number to an expense account. So it's something we've had on our list and we are working on, and I'd be happy to keep the finance committee up to date on it.
Yeah, if you would, I'd appreciate it. Thank you.
Wes, is there some way to incorporate that into the monthly financial stuff, or would it be better at the committee level or at quarterly levels? I'm not sure how often we would need to report on that.
It's probably better at the committee level. We could do it quarterly or just, before the audit, or, just give, depending on what the committee's preferences are. It's something that's going to, it's a work in progress with IT and finance. So we'll get it done as soon as, IT has the time to make it a priority.
Okay.
Hey, Wes, a little bit different, but similar. So a couple hours ago, a resident had sent me a photo of a geyser shooting with our water shooting in the sky about 75 feet over there in Discovery and Bent at that construction project. And Glenn looked into it for us, and it looks like one of the city's contractors had hit the line and broke it. How do we recover, or do we recover, like water loss and other repair? Our team went out there to repair it, but do we recover that?
So that's since it's a city building, I'm not really sure, because typically we have cooperative agreements with the city. We might though, but typically we would do the same thing as a reimbursable project on that, where we would set up a reimbursable project, charge all of our costs to it, and later bill them for it and see what they can pay us.
Yeah, like this one today is a good example, Director Sinella. We got our construction crews involved out there to shut things down. We also had our water operations folks out there doing an estimate of how much water went through the system, right? How much water did we not charge for? So we'll put dollars to all of that stuff. We'll track our time. We'll put dollars to the water that was lost. And then we'll approach the city's contractor and tell them this is what you owe us. And obviously, if they don't pay it, then we'll go through whatever process we need to. But typically they will when we can identify who did it. But yeah, we always track our time and all of our costs associated with it, and at least try to recover the money associated with that.
Yeah, thank you.
You're welcome. Wes, anything else on that, or Director Martin? Anything?
No, I'm fine. Great job for 3 years. I really appreciate it.
Yeah, so one other comment, GFOA's best practices actually typically do recommend around 5 years for an audit firm. However, as we mentioned, we have a plus 1 year extension for 2 years at the discretion of the board, but they typically don't recommend more than 5 years.
Yeah, so we'll probably bring this back through the finance committee and then ultimately onto the board. As Wes mentioned, we're not in a super big hurry, right? Because the next time is a year from now when we're doing, well, a little before a year from now when we start the audit for the next year.
And then just one last comment on that. We mentioned that it'll be presented at November 18th board meeting. After that, we'll be working on the CAFR and preparing all the checklists and getting it ready for submission to the GFOA for the award. And that's going to be due on December 31st.
Thank you.
And it was a big accomplishment. I don't think I even mentioned, but we will at the board that you did get the award last year. So
Yeah.
that is a big accomplishment too.
Yeah, for sure.
All right. Thank you.
Thank you, Shannon.
Thanks, Shannon.
Okay, we're moving on to number 2, annual investment policy.
So the annual investment policy will be presented by Jenny Linkowitz. And as you know, the staff is required to bring the investment policy before the board every year for an update. So the first item up for discussion will be the annual investment policy update. After that, she'll give us some updates on the portfolio and its performance. So Jenny, I'll turn it over to you.
Where'd Jenny go?
I don't see her on the as one of the participants.
Yeah, she dropped off. There
Oh.
she is.
She's back.
I'm sorry about that.
Yeah.
I just closed out of some systems because I think it was overtaxing my my computer. So let me just share my screen here. So good afternoon, everyone, honorable directors and staff. Thanks for inviting Chandler here this afternoon. And can you all see the policy okay?
Yes.
Yeah.
Okay, great. So I just wanted to bring you up to speed on some recent changes to California Government Code and Chandler's best practices. And I just want to let you know that none of these changes that are in the document are required by any means. It's up to you. Some of them I think are, we recommend more than others, but I just wanted to just make you aware of all the changes that did happen to code so you have all the options available to you. I just want to start out. The first one is it's page number 4. And this is not a change to code, but rather it's a change to Chandler's best practices in terms of the investment policy. So under authorized financial institutions, depositories, and broker dealers, we recommend adding that broker dealers be added to the list. They weren't on there before, actually. So for best practices, we'd recommend adding that to the list of people that the district is authorized to do business with. And so this is what we have on here is consistent with California Government Code 53601.5. So all the language that's in here is similar to California Code. Any questions about that one? Okay. All right, I'll move along to the next one. Another recommended change we have, and this is just a change to our best practices. You may or may not want to adopt this, but the second one is a recommendation of increasing the limit per U.S. agency from 25% to 30%. And so this would be, examples of this would be, for example, Fannie Mae or Freddie Mac. We do recommend having a limit. So, I mean, state code doesn't actually have a limit per agency. If you wanted to, you could invest the entire portfolio in one agency, but we recommend having some sort of diversification. But we recommend increasing that to 30% to increase in case there's a lot of opportunities in one particular agency at a given time to allow those to be purchased. And then the third one is in regards to commercial paper. And this is one that really you can consider if you'd like to add it. It would make it more consistent with California Code. And you're currently allowed to buy commercial paper issued by corporations. And this would allow the district to also buy another type of commercial paper that's permitted by California Code. And that is CP issued by limited liability corporations. So for example, asset-backed commercial paper, which typically it's issued by, for example, JP Morgan might have some asset-backed programs, and it would allow you to purchase those types of things. There's a German agency called CALS that issues this type of structure. So it would permit you to purchase those things. And this wasn't really something that we recommended in the past. However, there's been some recent changes by the SEC to the QIB rule, the Qualified Institutional Buyer rule, and the Accredited Investor rule, that permits government bodies to actually purchase private placement type paper. So given that is going to take effect expected on December 8th, we think that it might make sense to make the policy more in line with what California code permits in terms of commercial paper issuers. Okay, and then the next change in the commercial paper section, this actually, I'm not sure if this is one that you want to adopt or not. It's part of Senate Bill 998 that was passed and signed by Governor Newsom at the end of September. And this takes effect at the beginning of next year. So this would permit, if the district assets totaled more 100 million, actually more than 100 million, then the amount of commercial paper that could be purchased in the portfolio could be increased from 25 to 40%. Currently, the district's assets are sitting at about 72 million from what we have in our consolidated statements. So I'm not sure if this is something you would want to consider, in case the district were to grow in the future and or if you had some bond issuance that, with bond proceeds that could cause your assets to be higher than 100 million, then it might be something you want to consider. The Senate bill has a sunset on January 1st of 2026 unless it's extended. But this is something I just wanted to put out there just so you're aware that it's an option that you have at your disposal. Okay. I'm just going to continue on unless anyone has questions. These changes are part of the table. We've already discussed these. If you decided to increase the amount of federal agencies concentration from 25 to 30%, that would be there. And then under commercial paper, if you decide to adopt the 40% in commercial paper increase, then that would need to be footnoted here. And then the next part of the Senate Bill 998 is something I hope that we never have to use, but this is an exception that was granted as part of the bill starting at the beginning of the year, allowing California public agencies to purchase securities that have a zero interest rate or a negative interest rate. So I think it's more of a, in the past they had that in there, I think to prevent, someone from making a bad investment. But I think with interest rates so close to zero, we're in a position where it's not unfeasible that there could be negative rates at some point, and you might want to purchase something at a zero yield to avoid having a negative yield, for example. So if this is something that's not really palatable to bring up, it's not required. It's an exception that, you could leave the policy as it is here. But here again, it's something that would, sort of get ahead of, potential situations that could occur. In countries like Germany and Japan, they're seeing negative interest rates, and hopefully we don't get there. I think, I don't think the Fed is inclined to go that route, but we have seen some situations where some money funds have negative yields, or short treasuries, for example, have negative yields and things like that. So if we were in a scenario where a lot of things were negative, that is a situation where you could potentially want to have this option. Okay. And on page number 10, I just have a recommended change to some of the language. This is just a housekeeping item. Instead of saying money mutual funds, I recommend correcting that to include mutual funds and money market mutual funds. So that's just that's a clarification more than anything. And then the next change I've got here is in regards to the downgrade policy that's in the investment policy. The way it currently reads is that if a security is downgraded below the minimums for investment in the policy, that we would need to talk to the treasurer before taking any action. And so we're recommending that be softened a little bit to allow us, if a security, we saw in March, there was a lot of turmoil in the market and there were a lot of downgrades and things like that. So our recommendation here is to soften that language to allow us to take action and report it promptly to the treasurer after such action is taken. And I believe that is all I have. So does anyone have any questions or comments about the proposed changes?
I don't.
The only comments I had is I like them all. The one about the the negative interest rate. I don't know if we need to have that one. And then the one that references the 100 million plus or more or less. Then I don't know if we need that. But other than those two, I think I'd be supportive of all the other recommendations.
Okay.
Does staff have any thoughts or opinions on this?
No, I think we're in line with the recommendations. Wes, when would this come before the board?
That will be the December 2nd board meeting.
Yeah, and just because I'm just one board member, so I mean it's just that was kind of my initial thoughts when I was reading through it and then heard the presentation. But you can present it to the whole board with all of the recommendations, and then we can discuss it as a board. Then I don't have strong feelings either way. I just think that I kind of like having that little stricter language about the negative interest rate policy, and the more or less 100 million. I think it's a moot point anyways. But like I said, I don't have strong feelings either way.
Yeah, I think at some point in the future, 100 million is foreseeable, but it's going to be many years before we get there. So we're in no hurry for that recommendation. And I would add for both the committee members that in items like this, when we take it to the committee on its way to the board, it would be, if you guys want to make a recommendation, we'll incorporate it into our staff report. So if you think it's something that if the committee supports these recommendations, we'll put that in there. If you don't want to take a position, we'll just be silent on the committee's feedback on the item. Totally your choice.
I'm okay with just leaving it silent. What do you think, Director Martin? And then we'll just review it as a team, and then we can have more discussion about it then as a group.
I think that would most certainly be appropriate.
Okay. Jenny, anything more on that? Or are we ready to move into the third item?
I'm ready to move into the third item if that works for you all.
Okay.
All right, let me find that screen.
And the third item will be an update on the actual performance of the funds.
All right, can you all see the presentation?
Yep.
Okay, great. All right, so I'm going to start off with a brief economic update, and feel free to chime in if you have questions along the way. I'm going to kind of go fast in the interest of time, but if you want me to drill down into any of the things I'm talking about, just let me know, and I'd be happy to do that. So I'm happy to be presenting on a day when we have actually really good news in the market and for the United States about Moderna's vaccine progress. So that, it had a really good impact on the market, along with the Pfizer announcement a couple of weeks ago. So, we're starting to see a light at the end of the tunnel for the U.S. economy. And so we're still expecting to see a fair amount of volatility in general. And when we're looking at the data, another theme that I think you're going to notice is that the rate of recovery has been really dramatic, and it's been better than expected. But we're starting to see that rate of improvement start to level off a little bit as some of the fiscal stimulus that was put in place early in the year has started to wear off. So in the absence of additional fiscal stimulus, if there's a delay, maybe into next year, for example, we could see that sort of weigh on things a little bit. But the Fed in general is expected to use whatever means necessary to continue to support the economy. Low rates are going to be another theme that we're going to see out there. Obviously, the Fed dropped short-term rates down by 1.5% back in March, and they instituted massive buying programs and lending programs in terms of repurchase agreements. They're still buying $80 billion of U.S. treasuries every month and 40 million or more of U.S. agencies every month. So they're continuing these things. A lot of their purchase programs that are buying corporate bonds, they've been involved in high yield for the first time ever. Commercial paper, a lot of those programs are set to expire at the end of this year, but it will be interesting at the Fed meeting in December to see if they decide to extend any of those programs. I think we'll get some more clarity in the future. And then fiscal stimulus has been really helpful. As I mentioned, it's, started to wear off. We're looking at, the projected outcome of the election as a big indicator of how much fiscal stimulus and what the timing of fiscal stimulus could be. And we've already had $2.7 trillion, which has been really helpful and really instrumental to kind of boosting the consumer. We'll see the effects of that as we go through the presentation. But if we do end up with a projected outcome of a Democratic president and a Republican-controlled Senate, that's sort of our base case at this point. So having a mixed government like that favors a smaller additional fiscal stimulus package. But I mean, industries such as airlines and some of the individuals that have been displaced due to their work in certain industries that have been heavily impacted are going to be ready for stimulus, I think, in the near future, because we're really getting into some times right now where with the holidays and everything, we're really seeing a strong wave of cases. So it's something we'll be looking for, to determine the health of the U.S. economy in the next few months until we can bridge over to the vaccines, which should take place next year. So we do expect the Fed, to be, we've seen a dramatic improvement in unemployment, since the record 22 million jobs that were lost back in April. The good thing is we've gained more than half of those jobs back, and we've seen a really dramatic improvement of that. The most recent unemployment report for October was much better than expected. It was positive 638,000 jobs, starting to show some signs of leveling off here, but we are seeing, we're moving in the right direction. Let's just put it that way. And this has pushed unemployment from the highs we saw around 15%. It's gone all the way down to about 7%. So much, much, much better. I mean, before the pandemic, we were seeing about 3.5% unemployment, but that was exceptionally low. So we're still seeing elevated unemployment levels. We're above probably what the Fed would consider to be full employment. And so they still have some work to do, but this gives them runway to keep interest rates low for a prolonged period. I do want to mention that in California, we have seen higher unemployment than the national average. I think it's mostly because of our heavier exposure to the leisure and hospitality industry. The data is a little more lagged, but for September, unemployment in San Diego was 9% in the county, and then in the state of California, it was 11%. So we have seen that elevated in our area. And then the underemployment rate is sitting at about 12%. So those are all still, we have a little bit of wood to chop, but definitely moving in the right direction. Then this slide shows us unemployment claim data. And so the green bars are the number of unemployment claims every week. So we don't have it on this chart updated, but for November 7, it was 709,000 unemployment claims took place. So just to give you some perspective, before the pandemic, this would be about 200,000 or so. So we're still seeing a lot of unemployment claims, but the trend line here is the continuing claims that we're seeing every week. And that's moving in the right direction. It's all the way down to 6.8 million. So still well above the 1.7 million or so we saw before the crisis. But we've really made some dramatic improvement in this department. And taking a look at inflation, which is the other part of the Fed's dual mandate, they're looking for full employment and stable prices. So they look at CPI. I mean, you can see it took a major dive. The recession was disinflationary, but as the economy started to improve and energy prices have rebounded, for example, we've seen CPI bounce back. It was about 1.2% for October. And then PCE was sitting at about 1.4%. The Fed pays special attention. They prefer core PCE, which excludes the volatile food and energy components. That was sitting at 1.6% for September. So that's still below the Fed's target. They'd like to see it at least 2%. But Fed Chair Powell mentioned that he's willing this time to let inflation run well above 2% and use flexible average inflation targeting instead of just waiting for it to get to 2% and then maybe raising rates. He's going to let it go well above that and really let the economy get a strong recovery before even considering. So the implication of that is that we could see interest rates low potentially for years. And the Fed's dot plot indicates that they're prepared to leave rates low at least through the end of 2022. But I think it's going to depend a lot, obviously, on what we see in the market and how fast the recovery is. We could see everything recover really quickly once a vaccine comes onto the scene. One thing that's been really, really positive has been the consumer. So we look at retail sales as a measure of that. And by all, we saw some really negative numbers, obviously, back in March and April, but the consumer has really rebounded. And one of the things that's really helped has been the savings rate has been at record highs. In April, it was at 33%. A lot of people took their government stimulus checks and put them in the bank rather than spending them. So it's really cushioned the blow of some of this. And as a result, we haven't seen large amounts of delinquencies in things like asset-backed securities or credit card receivables or mortgages, for example. Some of that's due to government programs, but also some of it's been due to the consumer being very conservative with their money. So we saw retail sales were up 5.4% year over year. So that's really strong. We saw particular strength in the home and garden supply as a lot of people have been buying homes for the first time. We'll talk about that, but that might be a reason for it, but it's been really, really strong. Consumer confidence, it looks like it's dropped, but it's actually above average. It's sitting about 101 and on this survey. So it's above the 95 long run average. So we were just so high before the pandemic, but we're still in really good shape here with consumer confidence. I think a lot of people feel like they're on pretty good footing right now. I'm in the interest of time, I'm just going to skip over to housing, which is another bright spot. Housing starts were 1.4 million annualized. So you can see there's kind of a trend towards single family, which is the green bars. So a lot of people moving, out of the cities, buying houses out in the suburbs or out in, Inland Empire type places have been doing really well as far as housing prices. And that's reflected in the Case-Shiller number here. For Case-Shiller, overall nationwide prices are up about 5% year over year. And we're seeing higher than that here in San Diego. It's up about 7.6%. So I think San Diego has been a net beneficiary of some of the people moving from the more expensive urban centers like San Francisco. They've been moving to places like LA and San Diego and inland as well, to places like Tahoe and buying vacation homes and things like that. So let's see, manufacturing has really rebounded. We're not back to where we were, but you can see it's really rebounded from the shutdowns and the supply and demand disruptions that we saw earlier in the year. And then that all kind of winds into GDP, which is how we measure the US economy. So the National Bureau of Economic Research determined that the US officially entered a recession back in February. And we might actually be out of recession currently. You can see we went all the way down to a record negative 31.4. But that's an annualized rate. So we were really down, the GDP was really down 9% on a year over year basis in the second quarter. And then the recovery of 33% was really reflective of a decline of about 3% year over year. So we're expecting somewhere between -3 and -4%, I would say, for economic, not growth, but decrease for the year. And then next year, we're expecting a 4% rebound. So 2021, we're supposed to get a lot of it back. So the Federal Reserve has, to buoy the economy, they've increased the size of their balance sheet dramatically. During the crisis, it was sitting at about 4.5 trillion at the high. Now we're at 7.2 trillion, and it's growing slowly, not as fast as we might have thought, but it's still quite elevated. And then this on the chart on the right shows the Fed funds rate, and you can see that precipitous drop back in March. So that caused bond yields to drop. So you can see bond yields have been on a downward trend for the last 2 years. And the bond market actually predicted that yields would be going down. You can see there was a little bit of an inversion in the yield curve on the dark green line on the right. So last year, it really did show us that that yield curve inversion predicted once again that the thing was to go long at that point in time. But we're sitting here looking at yields on the 2-year part of the curve of about 0.18%. And then the 5-year is sitting about 0.4%, and the 10-year treasury is sitting about 0.9%. So not too far off of the record lows that we saw earlier in the year. And then the curve, the most recent depiction of what the yield curve looks like, short treasuries are on the left and long treasuries on the right. You can see we've gotten a lot steeper as prospects for the US economy have improved. So that's good, because that means when we're buying securities longer term, you're getting more of a reward for doing that. And so this just indicates that the prospects for the economy are positive at this point. Okay, does anyone have any questions about the economy before I move on to the account?
Not me.
Okay.
Nope.
Okay, great. All right, so we'll talk about the investment objectives per California code. Safety is first, liquidity is second, and yield is the third consideration. We manage the portfolio compared to the ICE, Bank of America 1 to 3 year US Treasury Index. So treasuries were a very strong performer earlier in the year. We have a more diversified portfolio. And so to achieve the objectives of beating the benchmark, we invest in high quality bonds that comply with your policy and also with government code at all times. So we have a rigorous compliance system that that matches up the portfolio with code and with your policy to make sure everything's in compliance. And so that's done at all times before I do a trade or after we do a trade, for example. This is constantly being monitored by both systems and staff. So it's a very rigorous process. And taking a look at the dashboard that shows the portfolio characteristics, we've got the benchmark comparison on the left, the 1031 data for the portfolio in the center, and on the right, we've got the previous quarter just as a comparison. So we can see that the portfolio, the duration, which is a measure of the interest rate risk, is sitting very close to the benchmark. We're about 98% of the benchmark duration. The purchase yield on a weighted average basis has declined a little bit as we've been investing in some lower yielding securities as things have matured off or gotten called. So that's gone from 1.88 to 1.75. But still, because your portfolio is a little bit longer term than something like a LAIF, for example, the yield that you're actually earning on the securities is actually much higher than those other short-term products. So that's hung in there very well. The market yield is all the way down to 0.25%. And that's reflective of the fact that there's capital gains in your portfolio. So you've got about $1.2 million in unrealized gains. So if we were to sell the portfolio today, theoretically, that's about what you would get if you were to realize those gains. Average quality is one notch below the highest. So the highest is AAA. You're at a high AA, so very strong. And then there was a small increase in the market value over the course of the quarter. So no big changes there. You're sitting at about 53, just shy of 53 million in Chandler managed assets. Okay, then taking a look at the types of investments that we've been purchasing for the portfolio. The biggest change, I think, has been moving maybe out of treasuries that have a lower yield and into U.S. agencies. So you can see that's gone from about 40% up to about 44%. And we've seen really a lot of issuance out of Fannie Mae and Freddie Mac in particular, because they've been taking all the callable agencies that they issued earlier years ago, and they've been calling those and rebalancing, they're refinancing their whole portfolio. So they've been offering better than usual risk premiums basically for purchasing those types of investments. And so we've had the Fed kind of involved in the corporate bond market. And, in March, there was a lot of turmoil and corporate bonds, the spreads on corporate bonds got really crazy. But then as soon as the Fed even talked about coming in, those spreads came in. And so we don't feel like we're being compensated, buying a lot of corporate bonds at this point in time versus agencies, because agencies have very little risk. So we've increased exposure there. This duration allocation chart just shows, it has kind of a color-coded way of showing how the portfolio is distributed. So we manage a 1-to-3 versus a 1-to-3 benchmark. So the majority of the assets are in the 1-to-3 bucket. And then you can see we also have some treasuries and agencies that are out a little bit longer term to lock in some higher yields out in that part of the curve. And then we also have some, kind of the diversification is sort of in the shorter with a 1 year or less. That's where we've got the asset backs and, some of the other things. This just shows, the changes in the allocation quarter over quarter. So the gray bar is the previous quarter and the green bar is the current quarter. So here again, the agencies and the treasuries are probably the biggest change. There hasn't been a lot of changes in the corporates. There wasn't really anything in the portfolio that we felt we needed to sell. We've been watching certain industries very closely, like automotives, for example, that took some downgrades early on when everyone was staying home and not buying cars and the factories were shut down. But those actually have come back pretty strongly. So we're keeping an eye on that. And then the bottom part of this slide just shows you how the duration has changed. The benchmark is the gray line. So we're kind of keeping, as you can see, we're keeping pretty close to the benchmark, which is where we want to be right now. This just shows the duration of the portfolio as the green bars versus the benchmark gray. And so you can see we have a little bit more diversified distribution versus the benchmark. And this slide just shows the issuer concentration. So, you've got a large percentage of the portfolio is invested in U.S. government securities. That's about 73%. And then the corporates that you have in the portfolio are very well diversified. They're very high quality. And we keep them, we don't want to be concentrated in any one company or any one industry too heavily. So you can see some of the bigger concentrations. For example, there's a Royal Bank of Canada CD that's pretty short term. That's about 2% of the portfolio. and then a Walmart bond that's about 1.6. So that's a very high quality company that's really done well during the pandemic. Here again, the ones that we were watching the most closely during the depths of the crisis were, for example, Toyota and Honda. But we've been watching it closely, and they've been doing really well. Auto sales have come back, not all the way, but they're still off about 4 or 5% year over year. But a lot of people have been buying cars actually to rather than take public transportation, or so they can go on vacation with their families, for example. So that's actually come back. The portfolio is rated single A or higher. The non-rated portion is just a couple of securities in the portfolio that have AAA ratings from Moody's and/or Fitch, not by S&P. So that's why it's like that on the slide. And then taking a look at investment performance, this is really our report card, if you will. So the benchmark is the gray bars, and the portfolio is the green bars on the slide. So this is going to include any interest income that's been earned. Also, it's going to incorporate the unrealized and realized gains that have happened over time. So since inception, we've had annualized performance of about 3.5. So we outperformed the benchmark by about 14 bips. Over the last 2 years, the last 1 to 2 years, it's been really strong annualized, just nominal performance. You don't normally see that with, in our low rate environment, but we've been close to 4%, like 3 to 4% in returns over the last couple of years annualized. So we've been able to beat the benchmark in all the categories, but that 2-year performance just is not something you see all the time. So, we're not expecting that that's going to continue. Obviously, now that rates are so much lower, a lot of the gains have been made, but we're going to continue to look for opportunities in the market. Okay, then the remainder of the presentation, we've got the reporting account that's managed by district staff. And so this portfolio, it looks like there's about 19.5 million. So this consists of a combination of LAIF and also the San Diego County pool. And LAIF is yielding right now, it's come down a lot, but it's still a pretty attractive liquidity alternative. It's sitting about 0.58%. And then the county pool, their reporting is a little bit lagged, but I look back, as of August, it was yielding about 1.2%, and the duration was sitting at about 1.2 years. So those are actually both doing very well for liquid type investments. Wes, was there anything you wanted to add about the reporting account before we move on? Okay. All right, so we'll take a look at the consolidated portfolio, and this just combines everything that we've already talked about. All right, so this just looks at this is kind of a bird's eye view of what the district's assets look like. So the average purchase yield, which is about the yield you're earning right now, is about 1.48%. So I'd say that's really, you're doing great considering how low yields are right now in the market. Quality is very high. There's about $72.4 million in assets there. And the sector distribution shows that you've got a lot of liquidity available in LAIF. And you're coming into December when typically public agencies are going to get a lot of their receipts. So that's a good place to be in. And you can see everything is well diversified, and there's a high percentage of very high quality government assets in the portfolio as well. So the remainder of the presentation just consists of the holdings and also the transactions. So if anyone has questions about anything I've discussed, I'd be happy to take those now.
Hey, Wes, could you or Jenny explain to myself and to the committee members the difference between the Chandler managed assets and the staff managed assets? So there's about 52 million managed by Chandler, about 19 by staff. So maybe explain a little bit why we choose those numbers.
Yeah, so typically we like to keep the operating reserves liquid. So we like to keep around 13 to 14 million, which is our 180 days of operating reserves in LAIF and the county pool. The rest of the money is usually transferred over to Chandler for them to invest.
Okay, thank you.
And I would like to note that, as Jenny mentioned, our current yield is about 1.49, which is well above LAIF at 0.61. So thank you for doing that, Chandler.
I have a question.
Yes.
For Wes, actually. Wes, is there a way to quantify how we're doing now versus how we were doing when 100% was being managed by by staff?
So, it would be very difficult, especially given the recent events in the economy. With the Fed lowering the rate to 0 and everything that's happened with COVID, it'd be really difficult to compare what was happening before to what's happening now. All I can say is that, given the long-term nature of the portfolio, it's really seems to be working out well when you look at it in comparison. We were kind of benchmarking it to LAIF, which isn't always in my mind, it's like LAIF is our savings account. So if we're beating our savings account, we're doing really well. So I've got a historical, like how we performed against LAIF, and I'd be happy to show you that. But now that we're more than doubling LAIF right now, it looks like we're doing pretty well.
Great. Thank you, Wes.
Any other questions?
I'm good. Thank you. Great presentation.
Well, thank you. And I just wanted to mention that I saw there was a really nice article on the Aqua website about a coffee farm, the Blue Tail. That was really nice.
Yeah,
Oh,
yeah, it was a pretty cool story.
Yeah. All right. Well,
All right.
I hope everyone stays healthy, and happy holidays if I don't talk to you. And I wish you all a good night.
Yeah,
Thank you.
make sure you
Jenny.
stop sharing.
Okay,
So,
I'll stop sharing before I
yeah.
hop off here.
Thank you, Jenny. We appreciate it.
All right, thank you. Good night.
All right, we ready for the fourth item?
Yes,
Yep.
sir.
Let's see. Let me get it up on my screen.
And just real quick, so that's the CalPERS additional discretionary payment.
So I got a couple slides on that. It's just a brief update, so I'll just share that real quick. Okay, so as we mentioned, that's a CalPERS ADP update. I just wanted to let the committee know that we actually, first off, this shows the UAL funding policy that was approved by the board on June 3rd. And as you know, the plan was to send in $4,027,000 to PERS to make the additional discretionary payment. And an update on that, the payment was made on October 29th, 2020. And next thing I want to discuss is the projected balance as of fiscal year 2022 was at $7,273,000. The updated balance after making the payment from CalPERS is now projected at $7,690,483. That's just the result of the additional 2 bases for 2019. It was just a asset loss, and then we had a non-asset gain or loss of like 300,000 each. So that was brought it to around 7.7 million. So we were, and those are both estimates from PERS. So I'm not going to say that I was off on that because it's their own estimates. But looking at the 7.7, that's what will be projected for the next budget process. And as you know, our funding policy and our plan is to, originally this year, we had talked about paying it off over 2 years at the discretion of the board and funding the 4 million. And then we do annual policy revisions when the actual evaluations are released. So that's what we did before we made this payment. We'll do that again next year. We always maintain flexibility, so we're not locked in anything with PERS. We're not required to make any payments. Every year we'll bring it forward to the board for board approval and suggestions. And then we avoid overpaying. At this point, it doesn't look like it's going to be an issue, but every year we assess that. So we don't plan to overpay it. And then providing updates such as this one to the Finance Committee and the board. So next year, what we'll do is we'll bring it back with this policy and the payment schedule, the balance that we have, the most recent balance. And depending on how the budget process goes and what our reserves look like as we get towards the end of the budget process, we'll be bringing it forward to the board to discuss further. So I just wanted to give you that update, let you know the payment's been made. This is resulting in significant interest savings and is an excellent policy. And just another update for the committee tonight.
Yeah, and I just want to take a minute to maybe remind the committee where we were. If you rewound the clock back a couple of years, had this committee and the board not taken the actions that they did, we'd probably be looking at a $20+ million UAL. Is that close, Wes?
Yes.
So instead of 20, we're going to be looking at about a 7 million. And depending what the board chooses to do next year, we're going to drive that number to 0. So I think it was really good foresight by the committee and the board to address our most expensive liability that we have at the district. So good job. And I think we continue to go in the right direction.
Super.
I think that's all we have for you guys tonight.
Okay. Well, thanks, guys. Great information. Appreciate it.
Thank you.
I just have one quick thing to say. This may or may not be my last finance committee meeting. And Wes and Mike, you guys have been awesome. You've made finance meetings a pure, interesting, educational joy. So no of the silly banter back and forth. You guys have done a great job. Thank you very much. And I'm sorry I put you in the position you're going to be in for the next year or so.
Well, I want to say thank you, Director Martin. It's been a pleasure.
Thanks, Wes.
Thank you as well. Appreciate it.
Thank you, Mike. And Mike, thank your wife.
She's actually here in the background.
Oh, thank you very much for keeping him inspired and keeping him on the right track.
All right. Thank you all.
Okay, guys. Have a good night.
Good night.
Good night.
Good night.